Hello, everyone. Thank you so much for joining me. My name is Fawad Razaqzada, market analyst with Think Markets. My colleague Victor will be joining us shortly. So this webinar is obviously mostly about technical analysis than fundamentals, but please help us by writing your questions and comments in the chat box, and we will be more than happy to provide analysis on any particular market you're after. Before we proceed to the live charts, please take a few moments to read through the risk warning, which is coming up right now. These webinars are for general information only and are not intended to provide trading or investment advice or personal recommendations. Any information relating to past performance of an investment does not necessarily guarantee future performance. Think Markets shall not be responsible for any loss that you incur, either directly or indirectly, arising from any investments based on any information in this webinar. Please remember that the spread betting and trading CFDs carry significant risks and may not be suitable for all investors. So while we wait for other people to join the webinar, just a reminder that this webinar happens every Tuesday of the week at 11:30 London time. I think there will be one more before we break up for the Christmas holidays. And most of the time we spend talking about technical levels on live charts, on major FX, gold, and indices. We touch on fundamentals as well every now and again. As I said, please feel free to ask us questions, and we'll get to your questions as and when they are asked. So just very briefly then, things haven't really changed much from the previous weeks. Vaccine optimism is still keeping stock market bulls happy and keeping the bears at bay. We have seen some hesitation in European markets over the last couple of days, but we haven't seen a significant fall to suggest a trend reversal. But the bullish momentum has certainly slowed down a little bit. People are waiting for a breakthrough in the Brexit situation, as well as the stimulus packages in the European Union and in the US. And there's been no kind of breakthrough in the talks surrounding those decisions. And as a result, we haven't seen the markets move significantly in either direction in the last few days. In terms of economic data, then it's going to be a light one for data, and not many people care too much about economic data, dare I say, because obviously the focus is currently on the COVID situation and the lockdowns, as well as optimism surrounding vaccines. But we do have a couple of potentially market-moving macro events coming up, and not least on Thursday, when the ECB is likely to expand its QE program. So that will be a big day for the markets, and ahead of it, we're seeing consolidation for things like the German DAX index and the euro dollar as well. It's kind of paused a little bit after breaking sharply higher in recent days. So people are waiting for the ECB in terms of a economic macro event, but also talks about Brexit. That's becoming a major concern now, because time is running out, and we're no closer to finding an agreement than we were a few weeks ago. And recently, optimism surrounding a Brexit deal was lifting the pound. However, as we found out on Friday, talks broke down, and significant differences remain between the two parties. And as a result of that, the pound came crashing down from the 135 handle. Let's talk about the pound, shall we? Because we're talking about it right now. Actually, I will start off by the dollar index. Okay, so this is the weekly chart of the dollar index, and you can see that recently the dollar index broke through this long-term bullish trend line. So the path of least resistance is clearly to the downside for the dollar, and The index has been making lower lows, lower highs. Former support levels such as this black line has turned into resistance. A similar level is here at 91.75. We broke below that. That level remains exposed for a potential retest on this weekly time frame, which could then offer some resistance, leading to fresh falls. Currently, the index is testing 90.50, which is the base of this big breakout that we saw back in 2018. Then the index had consolidated here for many, many weeks before surging higher. So that level was never really retested after price or the index broke above it until now. So some of the hesitation in the euro dollar, for example, and the pound dollar makes technical sense because we are at a very important level for the dollar index. But given the underlying bearish momentum, I think there's it's more likely than not that this level will also break down and the dollar index will head towards and potentially below the 2018 low, which is at 88.25. So as things stand, the dollar index still is bearish, but there's a possibility that we may see a small bounce, at least a small bounce from this support level that's being tested right now on the weekly time frame. And if you look at the daily chart, we have bounced from there for a couple of days, with the dollar index printing a couple of doji candles, suggesting that there's great indecision at this level. People are not sure what to do. That's why the bodies of these candles are quite small. Neither the bulls nor the bears are in full control of price action. So this indecision is reflected in the euro dollar. I'll cover the euro dollar afterwards, but as I mentioned, the pound is making all the headlines at the moment because of Brexit concerns. Now, previously the pound was rising it's still rising inside this long-term bull channel, and then it was approaching the highs from earlier this year and the high of 2019 around the 135 level. That's the level I said that the pound is most likely to head to, and we got there on Friday of last week. We touched that level, broke above it briefly, and then it was rejected at the top of the bullish channel rather, before prices came back down quite sharply on Monday, and then it bounced back again. So we remain inside this bullish channel. The path of least resistance is still to the upside, I think. However, in the short term, because of this rejection at 135, you have to be very careful because the pound may have formed a major high there. You never know, but it may become clear down the line. So, if you're trading the pound, as always, you have to be careful. But now more than ever, it's really important to proceed with extra care, because not only do we have Brexit situation, which could really go either way, but also you have a possible reversal stick forming at the top of this rising channel and above the 2019 high, potentially a false breakout scenario. So just watch price action closely, and if you do trade it, please try to keep your position sizes small in either direction, because you never know which direction it could go. It's a lot dependent on headlines. So the pound has become really headline driven, and it really moves on anything Brexit related. So that's the key risk facing investors in the next couple of weeks, as people try to foresee what might happen in the Brexit talks. I personally think that a deal will be reached in the last minute, and so I think the pound is going to surge higher. But equally, we can't be too sure either, because the significant differences between the two parties still remain. So yeah, it could literally go either direction, and for that reason, you have to be very careful trading the pound. Now, last week I posted this chart in the week ahead report. This is the weekly chart of the cable. As you can see, the cable has been rising previously. People had been pricing in a Brexit deal, right? So the fact that some of the positivity has already been priced in means that if we do see a potential Brexit deal, then in most the potential upside could be limited compared to how much it could fall in the event of a no deal Brexit. Okay, because a no deal Brexit would really surprise everyone because so much optimism has been priced in already. So if we get a no deal Brexit, I think the pound could drop all the way to 120, because 120 is historically been a very important level, and that was the post referendum low that was hit in 2016 before the pound bounced back, and we came back down to the 120 handle a few more times, before staging a rally. So I think that level is really important, and a no deal exit could see the pound come crashing down to this level. Meanwhile, my base case scenario is obviously a Brexit deal. In that case, I think we will see a sharp rally towards 140s in the short term, and then thereafter it really depends on a number of things. How the UK economy is doing, what kind of a deal it is, etc., etc. So those are the key major levels that the pound could potentially head to over the next few weeks. So the move up or down could be really, really sharp, which underscores the need to be very careful when you're trading the pound in the next few weeks, because anything could happen. Let's talk about the euro. Now, the euro has reached this area of resistance, similar to how the dollar index has reached its own support area. See this consolidation zone? Well, the top of that consolidation is being tested right now on the dollar index. And if you look at the euro dollar, we had a consolidation here before the breakdown. So the euro dollar is the inverse of the dollar index, basically. And price has reached the bottom of that consolidation zone. So some hesitation makes perfect sense here. That said, the underlying trend is clearly bullish, as you can see on this weekly time frame. This is the chart I shared with you guys a few weeks ago, and I think I shared the last week as well, showing a potential scenario that could see the euro dollar rise above the 2018 high. Like 2017, we saw a major move up, as we did here in March. Then we had a period of consolidation, as we did here. And now price is breaking out again. And that was what happened in 2017 as well, the start of 2018, before the euro dollar ripped to 125, and then it slumped from there. So I think if history is anything to go by, then the euro dollar could be heading to 125-ish and possibly beyond that level over time. Now, this week, a lot will depend on the outcome of the ECB meeting. As we move to the daily chart, the European Central Bank is widely expected to expand its QE program. Okay, so under normal circumstances, when a central bank expands QE or cuts interest rates, this usually puts downward pressure on the currency. So, in other words, in normal circumstances, the euro dollar should go down if the European Central Bank were to cut interest rates or expand its QE program. However, these are far from normal times, and we're seeing the opposite happening. So we recently saw the RBA, the Reserve Bank of Australia, I think it was, who cut interest rates, and the Aussie dollar rallied. Now, the reason for that is really simple. Right now, it's all about risk on and risk off trade in the markets. And so if the European Central Bank does decide to expand QE, then this will most likely boost appetite for risk on trades. Okay, so in other words, it will boost the appetite for things like equity markets. And hi, Victor.
Hello.
My colleague Victor is yes, I can hear you.
All right, perfect.
So those of you guys who have joined us, I mentioned at the start that Victor was going to join us as well, my colleague in Bulgaria. So Here he is, and I think Eurodollar and the ECB is one of his favorite topics. So over to
Yeah,
you.
most certainly. So I wanted to we have come to a point where we have some consolidation, obviously in the euro dollar,
Sure.
and a couple of days in which we have seen lower highs and lower lows. And with having in mind the ECB meeting, which is coming up, I would be cautious. And I think that at this point in time, the risk-reward ratio favors shorts in the euro dollar.
Yeah.
So whenever you see any rallies, it would be good to fade these rallies, I think.
Right.
The ECB must be very, very worried about the current exchange rates.
Do you think that the ECB will be bold enough to do something about the exchange rate? Because obviously a higher exchange rate is not good for exports. Makes exports really expensive for foreign buyers, right?
Uncompetitive.
So and uncompetitive. So do you think
I
they will
don't
be bold
think
enough
that,
to do something?
Yeah, I don't think that they have any choice really. And historically, they have been very very proactive. We all remember a couple of occurrences where the European Central Bank has caused the euro dollar market to turn abruptly and materially. Such moment is that all famous "whatever it takes" speech by Mario Draghi.
Yeah, we all remember that. Yeah,
when we had the euro dollar at 145, and within 3 or 4 months, it was trading in the 120s.
Yeah.
So at this point in time, considering the increasingly uncertain winter for the European economy, and more and more lockdowns coming into force. We just had this morning Saxony in Germany, the whole region go into lockdown, and considering the fact that vaccine distribution is going to be a very, very slow process, and there remains the most complicated part of that, which is convincing people to administer the vaccine. That I think we have come to a point in the euro dollar where the risk reward trade favors being long the dollar, just when we see the dollar index testing its lows over multiple years, and it's a good time for a pullback, I think.
Yeah, I certainly agree. A small pullback, at least, could be on the cards this week. I'm just not too sure to say for certain whether shorting the euro would be a better trade ahead of the. I mean, we may see some downside follow through certainly, but I just don't. It all depends on what the ECB does, right? So if their actions don't please the investors, then we will probably see the opposite of what should happen, which is a fall in the euro dollar exchange rate. So they need to beat expectations, definitely.
One thing I wanted to mention on this matter is that there appears to be lack of expectation that the ECB will do anything material. Investors actually don't expect anything that will they've been driving the euro higher for the past 4 or 5 weeks.
But do you think
that in itself?
But do you think the fact that sorry to cut you off, Victor. I was just going to say,
no
do you think that the fact that they have been driving the euro dollar higher despite growing expectations that the ECB will expand QE, do you think that this was purely a reflection of a risk-on trade whereby people are selling the dollar, buying stocks, and by definition, if you sell the dollar, you buy the euro, right, to buy European stocks using the euro. So do you think that there was some element of that in play rather than investors?
Sure, there is. However, we're starting to see cracks in the stock market, I would argue.
Yeah.
Basically, the stock market rally is contingent on more easing.
Yeah.
How much more easing are we going to get? And is that easing helping the real economy? Just this morning, I saw this quarterly report by the Bank of International Settlements, which argued that we are now entering the second phase of the crisis, which is the solvency part.
Yeah.
And while there have been a lot of delayed payments over the past several months on loans made by banks, some companies are simply not going to survive this downturn, and their solvency will affect bank balance sheet, bank lending, and consequently growth. So the stock market rally is, of course, it's flying high on central bank money. However, with the regime change at the ECB and at the helm of the U.S. government, we could see something different come out from central banks. Because the only thing that this monetary policy has helped create is more and more inequality. And asset inflation for people who own assets. Very good for people who own assets, not very good for those who don't, and those are dramatic majority.
Yeah, and this brings us nicely to the chart of the Dow, because one of our attendees has asked about the Dow. I mean, what Victor's just said, the rally is certainly looking a little bit tired, to say the least, at these levels. And the Dow, there was a big level that at 30,000 that a lot was said about it, and in the media. We've hit this level repeatedly so many times over the last several weeks. Yet we haven't really broken cleanly away from it. And at the same time, we're seeing the relative strength index (RSI) near overbought levels, making a small negative divergence, with the index making lower highs while the index has been making higher highs, suggesting that the bullish momentum is weakening, and we could therefore see a possible correction in the Dow. I'm always hesitant to talk about the downside in the stock markets, because they can easily be manipulated by a tweet from Donald Trump, let alone actions of the central banks. So right now, it certainly looks like it is pausing, and possibly
it's starting to look wobbly. The only thing that we haven't seen is a lower low.
Exactly. So when we have a lower low, which low would you use, Victor, as your as the kind of level that you need to break?
Well, I would say that if we see a close below 29,500, I would definitely start to fade rallies.
29,500. Okay, so somewhere about here.
About 400 points below here.
Yeah. So this low here, if that breaks, then you think it's gonna crater.
Yeah. I think that if we see a sustained daily close below there, we could be in for a pretty good drop. I think that we have run out of bears. Nobody's bearish on the stock market, and this is usually a good sign for those that are willing to go short.
Yeah, sure. Yeah, I think there might be a case of rotation away from US markets and into European, because if you buy this growth story that things will start to improve from 2021 and so on, then surely European stocks which have been underperforming could play catch up with with the US market. So like things like the FTSE 100, which contains lots of value stocks that rely on economic growth. Things like that should, in my view, start to outperform. Now, when I say outperform, I don't necessarily mean go up. I mean, on the way down, they should fall less than the US markets. If the whole markets go down, or if the markets go up across the world, then the European markets should start to perform better in terms of percentage gains from their current levels. But since we're talking about the FTSE 100, recently spent several weeks in consolidation, and it has just broken above it at the end of last week. So the 6,500 level on the FTSE, which is being tested right now, is a key support level now, because previously it was resistance, right? So this level needs to hold for the bulls to remain in control of price action. However, if the index comes back inside this consolidation zone, that would worry me if I was a bull, because after such a lengthy consolidation, you want to see a clean break and a runaway kind of rally rather than hesitation, which is what we're seeing at the moment. So be careful if you trade the FTSE as well, because it could certainly tank with the other markets, even if it's going to fall potentially by less in terms of points than the Dow or the S&P, but it could fall nonetheless. So be careful if it goes back within the prior ranges. However, if it holds the breakout above 6,500, and we're currently holding above it, so if it remains above that level on a daily closing basis, then the path of least resistance would continue to be to the upside. But if it does come back within the existing ranges and close within this range, possibly in the lower half of this range, then that would be a red flag for me. So be careful. But right now, the path of least resistance is still to the upside. I think the DAX will be really in focus this week, because the ECB are meeting on Thursday. And if the ECB is as bold as we think it will be to do something about the exchange rate, then their actions might actually support the German DAX index. And the DAX is showing a very similar picture to the Dow and other major indices, in that it has been consolidating in tight ranges. Usually, consolidation is not a bad thing when it happens near the highs, because it suggests that the index is gearing up for a breakout. But sometimes this could also work against the bulls, as we saw, for example, in this situation here, when it was consolidating near the prior highs before it broke down. Nevertheless, the index found key support then at the 38.2 Fibonacci retracement before coming back to test the previous highs. So I think this time there is a possibility that the ECB could provide the DAX index a shot in the arm, and could see the index break above the post-lockdown high of 13,460. But whether or not they will get to the all-time high or break above that remains to be seen. So right now, it's not bearish yet. We are seeing, like the Dow index, we are seeing potential bearish signs coming in with the index losing momentum. However, like the Dow, it has not broken any key support levels to trigger, technical selling below broken support levels. So right now, it is in consolidation mode, and that's how you should see it. Don't try to foresee or kind of impose your views on it that it will break down or it will break higher. We don't know what it's going to do next. No one knows. But
sure.
The truth is, ECB is meeting, and usually on days that the ECB are meeting, almost always the DAX goes up. So I'm just pointing that out, really. So that covers the Dow and the DAX and the FTSE. We can see a question from another attendee. Which retailer would you trade, considering that they're doing very well at the moment? Victor, do you kind of get the question there?
I don't not normally trade retailers, but yeah, if you're bullish on retailers,
yeah, let us know if you've got a couple of retailers in mind. We can certainly look at the charts of those retailers. Yeah, I don't.
Well,
really...
let's start with the most popular one, Amazon.
Do you consider Amazon as a retailer stocks? Well, it is
certainly.
a retailer, yeah. But some people think it's more of a tech company than a retailer. But there you go. But yeah, it's probably as you said, the most famous one, isn't it?
Yeah.
Yeah. What do you see in Amazon, Victor? I see this going up.
To be honest. We see this crazy consolidation within a very wide range.
Yeah.
And yeah, a break of this triangle that you just drew will probably
lead to a
drive
continuation.
The next.
Yeah.
There is, like, we need to take into account when it comes to online retailers, especially in the US and specifically Amazon, there is a regulatory risk because of the change in the regime, the change of regime in the in the government could drive some action against Amazon, against antitrust action that can be a major something that it can trigger a major unwind.
Yeah.
But until that happens, I don't really see anything standing in the way of this stock going higher.
Yeah, no, you're certainly right there. Maybe.
How are the UK retailers doing? Do you have
I'm not sure, to be honest. I don't really look at individual names. But Next is a famous one in the UK. It's a kind of a boring company. It doesn't really do a lot, but certainly the trend has been bullish on Next since March, because Next, I really like the quality of their products, and also they have a good online presence. They were one of the first to kind of migrate online. They still have, like, retail brick and mortar shops, kind of, if you like, but equally their online presence is great. And most of the time now I shop from the Next website rather than the store itself. And so they have been able to capture the share prices, has been able to capture the stay from or shop from home trend that we saw during lockdown, and it's still going really strong. So I think Next is it has the potential to possibly break out from this consolidation and continue higher. Today's candle is looking somewhat bullish after printing a bearish looking candle yesterday. So we're seeing bearish candles not really bringing out the bears, which is usually a bullish sign. Prior resistance holding as support. So price action on Next is quite bullish in my view.
Certainly looks that way.
Yeah. Let's go back to the currency market, shall we? And there is one particular market that caught my attention this morning, and it's not one
Oh, it's an
that I
exotic
normally
one.
look at, but I think my internet connection is gone a bit slow.
We hear you fine.
You hear
At
me
least
fine?
on
Okay.
my end. Yeah.
Okay. So this is the weekly chart of the Aussie dollar against the New Zealand dollar. And to me, this looks really bearish because, we had these highs previously. The currency pair broke above it in
A fake
August.
breakout.
Yeah,
To the
and
upside.
it couldn't hold there. So when it fails like that,
Yes.
then usually, but not always, it goes all the way to the other side of the range, which is all the way here. I'm not suggesting it will get there, but given that now it's at a resistance area, this level here, which was formerly support, is being tested right here as potential resistance. So if you zoom in on the daily time frame, we've seen some hesitation around that former support level, which is here at around 105.50-ish. So watch out for a potential down move from there. And as a minimum, I think, if you do see another leg lower, then the liquidity resting below the most recent low at 104.15 could be the next downside target for the bears in this currency pair. Also catching my attention was gold and silver. We talked about gold and silver a few days ago, didn't we, Victor? And
Yes.
gold has been, gold was falling before, and I circled it around here because it was below the 200-day moving average. And at that time, the RSI, or the relative strength index, was at oversold levels, which was a very similar picture to what we saw over here back in March, when the RSI was also at 30, at oversold levels of 30, and the price of gold was briefly below the 200-day moving average before leading to a major breakout. So are we seeing a similar pattern unfold this time? That's a key question. Now, we were looking at this range of potential resistance and to kind of hold down gold. Well, yesterday we had a big move into that resistance range, and we briefly broke above it, but I think it needs to still go a little bit higher to give us an indication that it has indeed bottomed out. But the early signs are great. I think we are seeing good follow through after this reversal that was observed here. So going forward, the key level of support that needs to hold now is this level here, which was previously support. We broke below it, then tested it from underneath. It formed some resistance before breaking through it yesterday when gold formed a large bullish engulfing candle. So for as long as this blue level now remains intact, I think the bullish trend would be in place. But if you go below that, then I think that would complicate the picture. And we're seeing a similar picture with silver as well. Silver too has broken lots of resistance levels on the way up. And now it is testing the larger bearish trend line that has been in place since August. So it really needs to get through this before we can be confident that silver has also bottomed out. So the key level to break is this high here, I think, which was the last high prior to the latest breakdown. So if we go above that, we will have created our first higher high. Then what happens after that? Well, we don't know, but I would imagine if this level breaks, then we may come down for a while and then start to push higher again, something like that. But as a minimum, I do need to see that level break because that was the last high prior to the latest move down. So we need to see a higher high. I think, there's another question. Is it a good time to trade oil stocks? When you say trade, do you mean short
That's a
oil
good
stocks?
question.
Yeah, or long oil stocks?
Well, let's assume that since shorting oil stocks has been profitable for the past 7 months, our listener is asking whether it might be a good time to buy some oil stocks. Well, let's take a look at ExxonMobil, for example, ticker XOM.
Is it XOM or E? No, it's X. Sorry, XOM. I wrote E. Oh, yeah, that's it. This is the daily chart.
Yeah, this is the daily chart.
And the 200-day moving average is the blue line.
And as we see, it has stalled its rally. That the rally has stalled at 200-day moving average, and contingent on the breakout in oil prices, I think that this could be a good trade. But you really have to watch out for those for those oil prices. Because they have broken out of a recent consolidation, but the rally higher has stalled.
This is Brent, by the way. Daily
marked. You have marked the 50 level as psychological in Brent oil futures. I think that it could be quite bullish if we break above. However, we are seeing some hesitation at this point in time, and it would take I think it would take something fundamental for such a breakout to occur. Perhaps a more rapid deployment of vaccines than currently expected, or something really that makes people move more.
Yeah, sure. So from a technical point of view, Brent has is looking overbought, hasn't it, with the RSI at these levels after a major up move. So it makes some sense for oil prices to consolidate. So if you're bullish, you want to see some continued consolidation around these levels to allow the RSI to unwind through time rather than price action. And then if and when we do see that breakout, then oil stocks should go up as well, in my view. But I don't know if oil is a good investment long term, because obviously there's been a major drive for cleaner energy among European nations, and now in the US as well, with Biden winning the elections.
This is true, Fawad. However, I would say that there is a risk that over the past several weeks, oil producers have started pumping oil. Well, several months really. But over the past several weeks, they have made public that they're pumping oil now from their cheapest oil wells. Right. They're pumping out their cheapest oil right now, so they can make money on it. And those areas where it's more expensive to extract oil are currently not being tapped, because prices are not favorable, and capex, capital investment in the development of new oil is practically at very, very low level. And as we know, this is something that major investors like George Soros have put on the table, that the longer companies don't invest in the development of new areas where they mine commodities of any sort, the higher the likelihood is that at some point we're going to see higher prices for these commodities, because production capacity has been cut. And the more likely move is higher. Even if we drive this adoption to clean energy, the reduction of subsidies to the oil sector, for example, is also going to impact oil
production.
prices.
No, absolutely right. Maybe that's a longer term.
But that's the longer term thing. Exactly. Yes.
So in the short term, there's certainly a case that can be made that oil prices can indeed go further higher. Now, there are a couple of other questions that you've asked. What is the zigzag lines on the chart? Now, the zigzag line is literally a projection I made before prices broke out when it was in this consolidation. I literally selected this dude here, path it's called on TradingView, and I done something like this, that oil is going to do something like that, and I left it like that, and I haven't deleted it. I colored it in black, so that's what the zigzag line is. It's nothing technical. It was just me suggesting that oil will take a path like this in the future, which so far it has followed it, but it hasn't quite reached my $50 target yet. So I've left it there for that reason. The other question is, if I want to trade stocks for income, which sector should I look at? Well, first of all, let me say that we don't offer investment advice or trading advice in this webinar. We provide opinions, and what you do with that opinion is entirely up to you. And we don't provide any recommendations either. So we have to be very careful from a compliance point of view what we can and cannot say. Unfortunately, we can't give you an answer to that particular question because we'll get in trouble from a compliance point of view. But what we can say is, if you have any stocks in mind, we can certainly have a look at those and highlight some key levels and provide our opinion as to where those stock prices might go up or down to. So I'm really sorry, but we can't offer trading advice or investment advice because we are not allowed to. But yeah, like I know you asked about oil stocks earlier, and we looked at it from a purely technical point of view, and we provided some opinion in terms of what oil price might do, but we didn't say you can buy it or sell it. We don't do that in these webinars because we're not allowed to. So if you do have any stocks in mind, please write it down, and we'll certainly have a look at it, mainly from a technical point of view. Do you have anything to add to that, Victor?
Sorry, I was muted there for a second.
No.
Yeah, I don't have I don't have any particular. I see that our chat asks if we can discuss the levels on next.
Yeah, next as in the stock. Yeah. This level here, this blue level 6470, key level of support. This has held, and from here, I think if next breaks out of this consolidation, I think it will most likely head to somewhere
to its all-time highs.
Yeah. So I think that's the all-time high, wasn't it? Well, not really. I think this was the the previous all-time high was at 8176. So that's the major target. The more immediate target is 735. Call that 7350 for argument's sake. That's the most immediate target on the long side, should next break and hold above the triangle. Doesn't necessarily mean it will get there, but it's a objective target based on prior price action. And how it will get there, or how long it will take to get there, no one knows. An additional level you want to keep an eye on the downside is somewhere here, 6138, because that was the level prior to the breakout, this big breakout that we saw on this particular day. That level has not been retested. So if it comes back down to this level, we may see a potential bounce from it. We have run out of time. I can't see any further questions. And so thank you so much for joining us. unless Victor has anything else that you want to share, but I certainly don't have anything else.
I certainly think that you have spoken about Brexit before I joined.
Yes, I have. Yeah.
The only thing that I want to remind traders of the pound is that for some reason over the past several weeks, the market has basically priced in that there is no chance that Brexit deal can't happen.
This right here.
And at this point in time, I think that the risk of a no deal Brexit seems terribly underpriced.
Absolutely. So because of the fact that it has been being priced in, what Victor is saying is that if we see a no deal exit, we could see a larger move down than we would see a move up in the case of a deal. So because some of the positivity of a deal has already been priced in, so the potential upside is possibly limited to what the downside might be in relation to a no deal exit. So yeah, that do you think it's going to go to 120 if we see a no deal exit, Victor?
Well, certainly we could see a test of 120.
Yeah.
I don't see a reason why not.
It will be a major
happen rather quickly.
Yeah, I was gonna say it's gonna be a major economic, from an economic point of view, it's gonna be very, very bad for the UK economy because it will raise tariffs or taxes on imports. So everything is going to be more expensive in the UK, and likewise it will hit UK exports because Europeans will probably look elsewhere for goods that the UK produces.
Which are what? I'm just joking.
Financial services. That's what we do here.
Right.
Which is another thing, right? It's slowly moving away from London to Paris and the like.
So we have a good question. What is the effect of Brexit on the euro?
Yeah.
There is obviously a negative effect on the European economy too, because Europe has a huge trade surplus with the UK.
Yeah.
So many companies, actually, this could be a trigger for a major stock market correction.
Oh yeah.
It would speak it would speak to the levels of protectionism that governments are getting engaged in, and protectionism is never good for the stock market.
No, absolutely. We saw a case of that in the US when Trump was won the elections a few years ago. There was some worries about protectionism, and the stock markets went down for a while.
The moment he had this deal with China. The stock market broke up, and we could all see this reversal come due globally, and the markets interpret Brexit as a new era of deglobalization.
Yeah. So to answer your question, then I think Victor has answered it. It's going to be bad news for the euro, but probably not as bad as it would be on the pound, and therefore the euro pound, in an event of a no deal exit, should rally because the pound will fall faster than the euro. So we'll leave it at that. But keep an eye on Euro Swiss, because Euro Swiss is. I had painted two kind of parts for the Euro Swiss previously. One was to hold above this breakout level. It didn't. The other one was to break down support, which it may have happened now, to get us back down to this support area here before potentially the Euro Swiss rallies. Now, the Euro Swiss, the reason I mentioned it is that because the Swiss franc is considered to be a safe haven currency. So in the event of a no deal Brexit, then if you're bearish on the euro, then this could be the market to trade short, in my view, because it could literally tank as people move their funds into the safe haven Swiss franc and away from the euro. At this time of the year, should we look at the yearly charts? You should certainly look at the yearly charts every now and again, just to give you an idea of what the trends are. Mark out your previous year's highs and lows. But if you are trading shorter term, like on the hourly charts and daily, you don't need to look at them every day. You can have your major levels, like I have, for example, highlighted this level from June 2020 high, and kind of copy it across all your time frames. Maybe put a note on it. For example, I've created 8 templates, so yearly high and low. And what I can do with this is you can sync it to all charts. So if I do that, you will see it on all my time frames, including this one. So you can rename that. And it will rename it on all charts like that. So yeah, certainly it's a good time to look at your yearly charts. I would wait for the year to close. So during Christmas, when everyone's celebrating Christmas and the New Year, as traders will be looking at the charts, right? You could plot your charts on yearly levels on the charts around that time, if you get some time. But yeah, you should have the yearly levels on the charts, regardless of the time of the year, because they can potentially be, major turning points can happen around previous year's highs and lows. And there's lots of examples I can give you, but probably in another webinar, because time has run out. So thank you so much for joining us. I'm gonna be here, I think, next week, Tuesday, and that might be the last one before we break up for Christmas. Maybe there will be one more, I'm not sure, on the December 22nd, if Victor hasn't got any holiday plans, but I will be away.
Yes, certainly be in on the December 22nd.
So. Okay, so would you like to take that one?
Sure.
Yeah. Okay. So we'll have 2 more live webinars coming up. One next Tuesday and the one after that, and then that will be that for 2020. So I will see you next week, hopefully with Victor. And if you have questions in the meantime, please don't hesitate to get in touch via Twitter, and I'll be more than happy to answer any questions you have. Take care. Bye-bye.
Take care. Bye-bye.